All right, good afternoon. I'm Tom Trush, and today I'm with Jeff Haydock, President and CEO of EcoCFO, the only outsourced CFO and strategic advisor working exclusively with energy and environmental businesses. Today, Jeff is going to provide insight into evaluating companies for acquisition. So, Jeff, you ready to get going?
Let's do it.
All right. So now, what are some of the best reasons to acquire a company?
So there's a handful, really, and it depends on industry and a whole bunch of different factors that are, situation specific. But we'll speak in general terms today. I'd say first, and this is sort of a two-part answer, is expansion. Some companies have it within their strategic plan to expand into different regions in the country, different parts of the world, what have you. And acquiring a business that's similar to yours, or maybe they're even a direct competitor of yours, but in a different region, can be a great way to do that more quickly and probably less expensive, probably, than just doing it on your own and opening a new office, hiring new people, having to start a whole marketing plan in this new region and what have you. The sort of a quick way to do it is to just acquire an existing business that's got a presence in the region that you're looking for. Part two of the expansion piece, I'd say, would be if you're acquiring somebody with a product or service that's complementary to yours, or maybe it's not complementary, but it's a different space that you want to expand into, you can acquire a business that has a proven product or service, be it proprietary, or it could be a whole number of different things. This may be better than spending a bunch of money on R&D and what have you, and building prototypes and testing and all that. You just acquire a business with a product or service that you want to add to your own portfolio. Next, I would say something along the lines of patents. There's a lot of businesses that have hundreds and hundreds of patents, thousands of patents, whatever it might be. And if they are complementary to your own business, then this is a great way to sort of secure your position within, protect your ability to do what it is that you do. There are a lot of companies out there that build proprietary products and services and have them patented and do this to protect their own revenue streams in the future. It's sort of a risk management thing, and this would be another reason to acquire a company, is just strictly for their patents and the impact that would have on your own business. Third, I would say new revenue. If you're buying a service-based business specifically that has a lot of recurring revenue, this is a great way to expand the top line of your business, is to just buy somebody that has a nice book of recurring revenue year to year. And then if you're, say, a construction company or something similar to that, you might buy somebody for their backlog. They might have, depending on the size of the business, any wide range of dollar amount in terms of revenue that they have contracted and in their backlog and ready to be built in the next 12 to 18 to 24 months, depending on what industry it is exactly. So that would be another reason. My personal favorite reason, I always sort of enjoy recruiting and poaching people, because it's a great way to add to the talent of your own existing business. So some folks might buy businesses just for their talent that is currently working there. For instance, some business owners are married to their businesses, but they just might be phenomenal at what they do, and you may not be able to offer them a comp package that would entice them enough to leave their own business. Or perhaps they have employees that you've been trying to recruit for years, but no matter what you do, you can't offer them a package that'll get them to leave. They're really loyal employees. Sometimes the best way to get them is to just buy the business. Oh. I'd say there's really one more reason, but I wouldn't do this on this reason alone, and that's just if you've got somebody that's available to you at a really deep discount. But you have to make sure that they fill one of the other needs that I've discussed here already. But that is also helpful. I mean, you might not even be out looking to acquire somebody, but word comes down the wire that somebody's for sale or somebody's in trouble, and you can pick them up for pennies on the dollar. Then that would be another reason to consider an acquisition.
Okay. Well, I have a feeling that might tie in here with our second question. What are a few bad reasons that might seem like good reasons? You mentioned, if you see somebody at a pretty deep discount, that could be a good reason, it could be a bad reason. But what are some bad reasons that might look like good reasons for acquiring a company?
Sure. So that's a great transition, actually, because you're right. Just because somebody's available at a deep discount doesn't mean that it's somebody that you should be considering acquiring. There's probably a really good reason why they're so discounted. Maybe they're in financial trouble, or there's strife within management and ownership. There could be a slew of different reasons why somebody is putting themselves up for sale and going on, pretty much ready to go out of business. So it's not a good reason to acquire somebody just because they're cheap. You want to make sure that you're comfortable with all the reasons why they are discounted, and make sure that they sort of fit into one of the boxes that we discussed a minute ago about reasons to actually acquire a business. Secondly, it's tough to acquire a business because there's potential. And this is true more with startups than anything else, but some businesses just aren't going to make it. They're going to go bankrupt, they're going to fail, for a whole variety of different reasons, and this is particularly true with early stage businesses. If you don't have a comfort level with what it is that they're doing, or they're not well funded, or there could be a whole slew of reasons why they would go bankrupt on their own. But if they're not an existing business with a slew of paying customers and another reason to buy them other than there's just potential, there's got to be some security there that there's actually a real business to be had that you can grow and make scalable. On the flip side, for larger businesses, and I typically only see this in somebody like General Electric, where they're really, really large. They'll buy their smaller up and coming competitors just to shelve them because they make some product that competes with a GE product that GE has invested a bunch of money in developing and built a sales channel for it, and they can't really afford to let somebody start cutting into that business. So they'll just buy them to shelf them and not even not even sell their product anymore. This is a bad reason to buy a business if you are of smaller scale. If you're going to acquire somebody, don't do it just because you want to shelf them. Do it because there's a methodology, some sort of strategy or reasoning behind buying them that would make you or enable you to continue to sell their product or service. And I'd say the last reason, and this can be really troubling because this is sort of like when you get married. You're not just marrying the family, you're marrying your spouse, and you've got to make sure that the people that are coming along with this business are functional, particularly in the management team. These guys and girls need to be very capable at what they do. They have to be able to work well together. If they have problems within the employees that you don't want to deal with, you just need to make sure that you've got a comfort level with not just the product and the service and the company that you're buying, but the people that are there running the ship.
Kind of a side question on that one. How can you determine that? If the management or the employees aren't good to work with and they present some potential problems. Is there a way to find out that could be an issue?
Yeah, there's a couple different ways. One way in particular is to talk to their vendors. Try to talk to their vendors and their customers and see what their relationships are like with that company. It's tough to talk to the employees because like 8 out of 10 employees hate their bosses anyways, so you're probably going to get a biased opinion that way. But if you can go outside the business and find some people with good relationships or have been working with them for a while, they'll probably give you some opinions as to how they work together and what their relationships are like. And then aside from that, it's just a matter of spending some time meeting with and talking to the management and the ownership, because if somebody is really frustrated with someone they work with, then usually they're looking for anybody to vent about it to, and you can find out that way.
Okay. So obviously when you're acquiring a company, you need to get an idea of its value. What are some ways that you can determine a company's value?
Sure. So this is dependent on whether the business is public or private, what industry it's in, but let's stick specifically with private businesses for this. And I would say probably one of the most popular ways to do evaluation is a discounted cash flow valuation. And simply put, and this is very much a simple explanation of it, you'll project out over a period of time, 3 to 5 years, something along those lines, how much free cash flow this business will spin off. You'll add it all up and you'll assign it a discount rate. So let's say that the free cash flow for the next 5 years is $1 million. You'll discount it, 60%, 70%, something like that, to get yourself to a price that you would be willing to pay for that business. Now, usually, projecting cash flow there are a few different methodologies to do it, but there's some gray area, but not a whole heck of a lot of gray area. Usually you can agree with somebody pretty easily about how you're projecting out cash flow. But the real sticking point on discounted cash flow valuations is the actual discount rate. So this is really typically what ends up being negotiated out is the discount rate. The buyer always wants to discount it heavily, and the seller always wants to apply some sort of premium to it to get more money for their business. But that's kind of the sticking point that you're going to negotiate. And this is also true in a different form in our next valuation technique, which is assigning an EBITDA multiple. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And you'll look at their EBITDA for the last year or two, last 3 years maybe, to see if there's some trends and consistency there. Find a number that you are comfortable with, whether it's last year's EBITDA or an average of the last 3 years, depending on the trends of the business. And then you'll assign a multiple to it and say it's 3 times or 5 times or 10 times. The multiple is usually determined by two things: the industry that they work in, and two, if there are any comparable transactions that have happened recently where you can find what multiple is assigned to it. Now, this multiple is kind of like the discount rate. This is sort of where you start negotiating, because determining EBITDA is relatively easy to do, and you don't really have to fight much about a conclusion you're coming to on EBITDA, but it's always the multiple that becomes the negotiation point. So, you might fight over brand power, whether management's going to stick around, how many risks, how risky is this business? Are they driven by environmental regulation? Or do they have a bunch of legal problems right now? There's a whole slew of different things. This is sort of the fudge factor, the gray area that comes in on valuating a business, is that either the discount rate or the EBITDA multiple. Now, something entirely different would be sort of like a construction company, for instance, where a construction company is pretty much worth what they have in backlog. If you can project out what they might profit on their remaining or existing backlog, and then you take any assets that they have and subtract any of the debt that's owed on it, and add that number with the projected profit on the backlog, and you can come to a reasonably close number on what you might pay for a construction company. And there'll be some negotiating back and forth on that as well, but that's pretty standard for how to value something like a construction company, where it's contract to contract for money or for revenue, as opposed to annual recurring contracts, or you've got a product that sells pretty consistently. Construction is kind of a different animal.
Okay. Is there a chance,
I'd say
before we go on? Before we go on to some of those other ones, I wanted to touch on that construction company a minute. The idea you mentioned that their value really comes from the projects that they have waiting that have to get done. I mean, do you run across instances on construction companies where they just don't really have much in the hopper, and you might be able to get them at a discount? I guess that ties into our bad reasons as well, but.
Well, that's kind of a loaded question, because it depends on ownership, I suppose, is how I would answer that question. Some people have some construction companies are still owned by the original founders, and they're really emotional about it, and they don't get the valuations that they're typically happy with in order to sell the business. So trying to buy a construction company with that sort of scenario at a discount is unlikely, unless they don't have a transition plan. They don't have a second or third or a next generation that's going to come in and operate it as the owner starts to get older and ready for retirement.
Okay.
So that's definitely a situational issue. But yeah, I guess that's how I would answer that question. Okay.
Well, I kind of got you off track there for a minute. So go ahead. You can keep going on some of the other ways to determine value.
No, I'm good. I'm good for now. That pretty much covers it, at least for the purpose of time here.
Okay. All right. Well, let's go for the final question. Let's get into some ways that you can uncover some red flags or some possible problematic scenarios that signal a company isn't worth acquiring.
Sure. So, one thing in particular is that they just don't do anything that you can't do on your own. It's kind of a tough argument to make to acquire a business and invest whatever the number might be, a couple $100,000, $1 million, a couple $1 million to acquire a business, if you can do what they do with the people that you currently have and the tools that you have. Or maybe you need to invest a little bit of money in your own business to be able to replicate what they're doing. but it's tough to convince yourself or your board that it's worth spending the money on acquiring somebody that doesn't do anything particularly special. Second, I've kind of harped on this a couple of times now, but if you've got dysfunctional management, then that's a really tough situation. Maybe you can buy the business and just fire them all and put your own people in there, but that's going to be a question of whether or not the management and ownership want employment contracts or some kind of deal to stick around for 2 or 3 years after the acquisition. So that can be a really sticky situation, but typically dysfunctional management is something to stay away from. If this is a business that is highly dependent on something that they do that's proprietary and they need patents to continue to do this, then that's a risk. You need to really get a feeling for what they currently own in patents, what they do, or what patents they need to apply for, and if those are even patentable. You really need to get a comfort level with that, because if you've got a business that's dependent on a patent to generate revenue and they don't get the patent, then you've got a problem. If you don't have a good feeling for the industry, if you're acquiring this business to get into a different industry or expand into a different type of market, then you should probably get pretty comfortable with the sales cycle. How long does it take to close a deal from start to end and then actually execute on it and start to collect revenue on it? That typically gets underestimated frequently, I find. So make sure you've got a comfort level there, and then you've got to make sure that you've got some supply chain management homework to do. What's the lead time on the material and equipment that you need to buy in order to generate revenue, and definitely you need to be familiar with the regulations that drive the business. And that can be a real risk if you're not familiar, especially environmental or energy related, if you're not familiar with the regulations that either are risks to the business or drive revenue or what have you. You've got to have a comfort level there. I'd say another reason, if you find after spending some time with management that you just know more about their business and their market than they do, then that means they're probably setting themselves up for failure sometime down the road. So I'd sort of take a step back, and you might be able to get them at a discount later. But if you know more about their market than they do, then it's not something you probably want to get involved with immediately, unless you think that they're asking for, if they're undervaluing themselves, if they think that their business is worth less than you do, then it might still be a good reason to take a shot at it. And then lastly, I'd say our financial issues, and we could do a whole conversation based just on this, but a couple of things specifically to look out for are their debt and their liquidity ratios. If their balance sheet shows that they don't have the assets and the cash flow to pay off some of their, or at least meet their debt obligations, then there's kind of an issue there. They're not running a sustainable business. And I'd say you have to keep an eye on their trends. What do their revenue and EBITDA and profit trends look like over the last few years? Are they trending down or are they trending up? Why is that? I mean, it's funny, you look at financial statements and you see numbers on financial statements and you think that's a very black and white thing, but in reality there's a lot of gray area, a lot of questions to ask as to why a business is performing the way that it is.
Okay. Well, Jeff, I appreciate all the insight. Let's finish up here by just giving some quick information on how people can get in touch with you. They want more information.
Yeah, you can visit my website, www.eco-cfo.com. That's ECO-CFO.com, or email me directly, Jeff, Jeff, at eco-cfo.com. That's always a great way to get a hold of me.
All right. Well, perfect, Jeff. Again, I appreciate all the insight, and thanks a lot.
Thank you.